Oracle stock is down 12.6% today so far. But even with that, it's up 33% year to date. They just reported last night. Guys, this is what I want to talk about when it comes to stocks. They were in line on revenue. They beat on earnings per share. They reported $1.19 per share versus the Wall Street estimate of $1.15. And cloud revenue is up 30%. Their overall revenue is up 9%, but the stock is down 12.6%. Why? Supposedly because the revenue growth potential is not as high. Guys, this is exactly what I'm talking about when I say in the short run, stocks are a voting machine. In the long run, they are a weighing machine. To me, when I heard Oracle was down 12%, I thought to myself, oh my God, they must have missed big. They beat on earnings per share. They were in line on revenue, and their cloud revenue was up 30% over last year. What the heck is going on? So in this video, we're going to go over some news on Oracle, like we just discussed right there. We're going to go over our 8-pillar process, of course. We're going to cover some high-level metrics of the company, and then we're going to finish this. We're going to go over some analyst estimates, and then finish this off with the question you're probably wondering is, what's the price to pay for Oracle? We're going to use our stock analyzer tool to do that. Now, there's going to be something in this video for beginners all the way to more advanced investors. So no matter where you are on the spectrum, there is something in this video for you. And if stuff sounds confusing because you're more of a beginner, it's okay. It was confusing for me too. It was confusing for the other 200,000 subscribers to our channel, but just stick with it. Listen to more videos and it'll make more and more sense as time goes on. So let's check out Oracle down 12.8% now. All right. Market cap of Oracle is $304 billion. That means if you wanted to buy every share outstanding, it would cost you $304 billion. Something that's surprising here. I'm actually surprised by this. They actually have more debt than I would have expected. Their enterprise value is 426. So the difference between market cap and enterprise value is essentially their debt. Take all their cash, all their debt, add it together, boom. They basically have $122 billion of debt, essentially, just to make it very high level and easy. Now, their revenue, $51 billion, and their price to sales ratio of 6. Now, why do I bring up price to sales ratio? A great way to compare companies within an industry is to compare their price to sales ratio. It can allow you to compare things and see which one seems more or less expensive. Now, on Oracle, they have a 78% gross margin. That's huge. As an example, Microsoft is 68%. All right. This means for every extra dollar they sell, 78 cents of it goes to the bottom line to pay taxes. So if they sold an extra $1 billion last quarter than they expected, they would have added $780 million to their profit before taxes. All right. Now, something that's interesting though, their profit margin in the last year has been 18.4%. In the last 5 years has been 23.4%. Let's look up Microsoft, because I do want to show you guys Microsoft. Let's pull this up right here. Microsoft has a lower gross margin, but a much higher profit margin, 34%. And look at their price to sales ratio, 11.86. So actually it's pretty much double what Oracle's price to sales ratio is, but their profit is so much bigger. Their profit's a lot bigger than Oracle's. $2.5 trillion market cap. Look at their revenue at Microsoft, $212 billion. Oracle's is $51 billion. That shows that with so much higher revenue and even though they have a lower gross margin, for every extra dollar they sell, they make less than Oracle, but they have so much more revenue than Oracle that it leads to a much bigger bottom line. You know, Microsoft is more geared towards the average consumer. Oracle, you're using it's pretty much enterprise software, right? It's only for companies. Not only, but it's mainly used for companies, right? Actually, I don't know anybody who personally uses Oracle, but I could be wrong. So if I'm wrong there, please write it in the chat below where else, the average everyday Joe could use Oracle software. So there's a lot to throw out here, but those are the big differences. So even though Oracle has a significantly higher gross profit margin, they have a lower overall profit margin because their revenue is a lot lower. All right. Now, 5-year return on invested capital, very healthy, almost 20%. This means they get a really good return on the money that's invested in the business. This is a very big positive for companies. It means that they can invest more in their company and generate higher earnings as time goes on. They also pay a little bit of a dividend here, 1.3%, which cost them about $3.9 billion. And there's a reason the software, we put it right here. I want you to compare that to the last 5 years of free cash flow. They've generated about $10.2 billion a year over the last 5 years. So their dividends are only 40%, little less than 40% of their free cash flow, which I like. I don't want it to exceed 50%. I shouldn't say I don't want it to. That's what I look at to say, hey, is this a dividend they could cut? But it's a very low dividend yield. Now, PE and 5-year PE are pretty high, over 30. 32.5 in the last year, 30.3 in the last 5 years. Kind of concerning. Now, of course, with a high return on invested capital, you can justify a much higher multiple for the company. Because if two companies are exactly the same, but one can increase their profit at 20% of the money it's invested and one can only do it at 5%, which one would you pay more for? Of course, the 20% one. Because they're able to invest $1 and generate 20 cents in profit extra, while the 5% company invests $1 and generates 5 cents extra in profit. You would much rather pay a premium for this. But again, look at Microsoft. Their return on invested capital is 24.5%. So this is probably explaining you why the price to sales ratio is higher on Microsoft. Doesn't mean it's a permanent thing, but the PE and price to sales ratio is higher on Microsoft. All right, let's go back to Oracle here. They're down 12.9% now. Let's go to our 8 pillars real quick. Now remember, guys, if you're part of our community, you can customize your 8 pillars up to 12 different pillars here. So just remember that for everybody here. Now, a lot of X's here. 1, 2, 3, 4, 5. They bought back 30% of their shares. Holy cow. Wowzer. That's a big number. Not necessarily a good thing. Buying back expensive shares could be bad for the company. Let's see, what is their all-time high? 127 on June 15th of this year. And their 52-week low was 60 in September of last year. Wow, look at that, guys. It's doubled in the last year. Wait, how is that? Oh, 110, that's why. So September 29th, it was literally, it had a big drop. Look at that, big time. Holy cow. Incredible. I like seeing that. All right, so again, their 5-year PE is 30. Their 5-year price of free cash flow is about 30. So I like the fact that they're very similar to each other. It shows that they're generating net income and free cash flow in the same pace. I like that a lot. It makes me worry less about are there financial manipulations being done there, because it's easy to manipulate earnings. It's not as easy to manipulate free cash flow. So when they're together and pretty close, I like that. But I don't like the fact that net income is down $1.6 billion, free cash flow is down $2.7, and they have healthy debt like I talked about before. Now, am I worried about the debt as much? I mean, a company like this with such a high margin, and they're selling the company. Let's go look at how they did in the great financial crisis, the Great Recession. In 2007, they did $19 billion, went to $23 billion in 2008, and then it's basically 23. It fell minorly, but then jumped up big time afterwards. All right. Guys, by the way, just to show you guys how much you should not listen to your friends. In 2001, a friend of mine's father asked me what companies I liked. I said Oracle. And he said to me, I don't like their sales channel, the way they sell. So I sold the company. I'm like, oh, he must know more than me. He's smarter. They did $10 billion in sales that year. Fast forward, just 10 years later, they had over tripled. I mean, come on, just stick. What I'm trying to teach you here is a process. We're trying to teach you how to think independently and not make decisions based on other people. I'm not blaming him by any means. Not at all. But what I'm sitting there saying is you have to sit there and make independent decisions and not get affected by other people. That's very, very important. I'm trying to teach the emotional side here, trying to teach that process so that you can make better decisions for yourself that you feel more and more comfortable with. All right? All right, let's see what analyst estimates. Oh, it's over 13% down now. And guys, look at this. They're expected to make 514 in June quarter, ending June quarter for the year, growing to 773 according to analysts. Now remember, guys, analysts are not to be fully trusted. I have always said this. Take it with a grain of salt. But it's a nice way to look at the guidance here, saying, okay, what are they thinking? I don't think you should make decisions based on what analysts say. They have career risk. They have a lot of things they have to worry about, making sure they don't criticize companies too much. They want to make sure they get the investment banking business, etc. But it's a nice way to just take a look. Let's see what analysts are saying for revenue growth. Wow, pretty healthy. 50.8 billion up to 80.6 billion in 2028. That's some double-digit growth right there per year. Wow. Interesting. Very, very interesting. So they keep buying back shares. I wonder how much of this EPS growth is because they're factoring in buyback of shares. So let me go sit there. Let's go to their 10K. I want to see what their buyback program is. So guys, what I'm going to do here is I'm going to pull up their 10K off our website. You just go here to the annual report. It takes you right to the SEC page for Oracle. I tap right here on the right for 10K. Boom. The June 10K. Now, share repurchase, share buyback. Let's Google it. Oracle share repurchase. Over the past 3 years, okay, let's sit there and say. So, okay, Oracle's repurchased an eye-watering number of shares. That is true. Leaving the business bloated with debt. See, that's the thing. I look at the debt going, why would I want to maybe I would. Interesting. Let's see what they're doing here. Buyback amount. They've purchased $110 billion of shares since 2012. $110 billion worth. Wowzer. Going to the end of 2021, so it's still more since then. Let's see what their let's go back and see their core. So on our software, if you go to income statements, at the very bottom is share repurchases. Oh wow, they actually increased their shares outstanding in the last year. Let's go to quarterly. Yeah, slight increases in the last year, last 2 years. Wow, I'm kind of surprised by that. Very, very interesting. Dividend increasing, just increased recently. All right, guys. So we've gone through a lot of stuff having to do with the company, but it's not the deep level things. Now, I like to keep a higher view on companies because I feel like if I get too meddled in the details of if I don't like their sales channel, their sales process. Oh, okay, good. I know that a lot of people would say that's an important factor, but is it a real factor? I can dislike a lot of different sales processes. I just look at it saying, I want to look at their history and have they been able to implement their sales? Have they been able to keep consistent free cash flow net income? So let's go to their cash flow statement real quick, just to take a look at free cash flow. Now, if you remember, free cash flow is cash from operations less your capital expenditures, okay? You can do 5 things with free cash flow. You can buy back shares, pay down debt, pay a dividend, reinvest in yourself, and make acquisitions. All right, now, if you look at this, look at how much their capital expenditures have increased over the last 10 years. $630 million 10 years ago, 1.6, 1 billion, 2.2, 1.6, 1.7, 1.6, 2.7, 5.2, 8.3 billion in the last year. So their free cash flow has really dropped a lot. They're investing a lot in the future. It's important to understand what that investment is for. My guess is cloud computing. I could be wrong, and I have not looked at anything. We literally decided to do this video about 2 minutes before we hit record. But I want to sit there and look at these numbers here to understand more of that. So if you're in our community, by the way, tag me in the general chat and let me know what you think about Oracle. And if you could find out what this increase in capital expenditures over the last 2 years was for, I'd really love to hear that. My guess is cloud computing, because of how high margin it is and to show people that they can invest a lot of money and get a really high rate of return. So again, in the community, somebody please just go to the general chat and tag me and say, Paul, this is what I found, because I really want to hear from you. And I'm too lazy to do the research myself, so I'd rather hear other people, and that's why I created the community to begin with. So let's go figure out what price to pay. If you guys are interested in learning about the community, click this link above. It's a quick video about the community and how it can help you become a better investor. But let's look up and see if I've ever done an Oracle analysis. When was the last time I did Oracle? June 12th. So let's pull it up. I did a 20-year analysis. I'm going to do it down to a 10-year analysis. And let's see if I'm going to change anything here. So one thing I do like here, apart from the 1 year, the return on invested capital over the last 10 years is 17.5%. Over the last 5 is 19.5%. Yes, in the last year it's down, but I like this trend of increasing. I like when they're increasing the return on invested capital. That means that they're getting a higher rate of return as they invest more and more. A company like Apple has a hard time having higher incremental ROIC because where can they actually invest? Apple's so big. How can they invest more money? Oracle's big, $50 billion in revenue. But we see from other software businesses and other tech businesses, that's not the biggest. They have a lot more growth potential to do. Okay, so I like the fact that this is an increasing return. That means they're getting more and more return as they add more and more money to their investment in their business. Now, for revenue growth, I did 3, 6, and 9%. Over the last 10 years, they did about 3% a year. Last 5 years, about 6.6. But in the last year, it jumped 15.4. So I'm actually going to go a little bit lower. I'm going to go 3, 5, and 8. Because I don't know if that's a reasonable amount here. Now for profit margin, I did 21, 23, and 25. Okay, looking at their history, that looks about right. For the free cash flow margin, I did 25, 28, and 31. Now, guys, for the PE is, what's the PE going to be at the end of this 10 years? We have no idea. But what PE are you willing to pay for this company in 10 years? My recommendation, everybody, is start at 15. You go higher with a higher return on invested capital and a higher growth rate and bigger moat. And you go lower for the opposite. Oracle is pretty set in their corporate world in the terms of where they sell to their market. They're a very high player. The only one I could think of, SAP in Germany, I think is a big player, a big competitor to them. But I look at this saying, okay, am I willing to pay a premium? I'm actually going to go a little bit higher here. I did 15, 17, and 19. I think I'm going to do 15, 18, and 20. Even though it's not even distribution here, I still am okay with that. And for desired return, I originally put in 10% all across the board just to get an idea of what I thought Oracle was worth. But I want to put my margin of safety in there. And the higher my assumptions, I need to put a higher margin of safety, which means a higher return. So I'm okay making a 10% return if the lowest assumptions occur. I'm going to go 10, 11.5, and 13. I'm going to hit the analyze button. Now, guys, I just need you for 1 or 2 minutes longer. Just hear me out on this thing. So I want to explain the numbers below. It's super important for our channel. We're trying to teach a process here. Our goal is to appeal to people who want to learn and make their lives better, not someone who just wants to be handed a bunch of fish. We want to teach you how to fish. That's very key here. So just listen for 1 more minute. Oracle is now down 13.6%. So in the time we've talked, it has lost $2 billion in market cap. That's an incredible number. So I hit the analyze button, boom. So I got a low price of 55 to 65, a high price of 90 to 111, and a middle price of 70 to 85. So if I pay today's price of 110 and the low assumptions occur, I'm going to make about 2.8% return. Not very good. If the middle assumptions occur paying today's price, I'm going to make about 7.8. And by the way, these all include dividends. And if the highest assumptions occur paying today's price, I'm going to get 13.2. So guys, I'm actually going to add it to my watch list at $80 per share. It's going to notify me via email, via my phone, where all of our software and community is located, and on the software here on the page when it hits 80. Guys, thank you very much for your time.